We are diving into the single most important macro catalyst on the calendar right now, Friday's June non-farm payrolls report. And there is a wrinkle that Wall Street cannot afford to ignore. Goldman Sachs is estimating the FIFA World Cup, hosted in North America this summer, could mechanically add approximately 40,000 jobs to the headline June payroll print. That matters enormously because the street consensus is sitting at 115,000 total jobs added. Strip out the tournament effect, and you are looking at an underlying labor market that may have produced closer to 75,000 jobs, a number that tells a very different story about economic momentum and Fed policy than the headline will suggest. Here is the specific mechanics of what Goldman Sachs is flagging. Seasonal adjustment models embedded in the Bureau of Labor Statistics methodology were calibrated years before a Summer World Cup in North America was on the calendar. That means the BLS model does not know to strip out the temporary surge in hospitality, security, transportation, and event staffing that a global tournament of this scale generates. Goldman estimates that distortion alone is worth 40,000 payroll jobs in June. With consensus at 115,000, a headline beat could therefore be almost entirely explained by stadium workers, hotel staff, and event contractors, not by durable hiring in manufacturing, tech, or financial services where Fed policy actually bites. The danger here is not the number itself. It is the policy interpretation risk. If the June headline comes in at or above 115,000 and market participants and Fed officials read it as genuine labor market resilience, the hawkish repricing that is already underway accelerates. The 10-year Treasury yield is sitting at 4.53% today, up 0.98% on the session alone. The 5-year yield is at 4.26%. An inverted curve persists with the 13-week T-bill at 3.72%. These are not the signatures of a market pricing in imminent rate cuts. A World Cup-inflated payroll number risks cementing the Fed's higher-for-longer posture based on data that flatters to deceive, delaying any pivot the labor market's true trajectory might actually warrant. Every major asset class has direct exposure to how this number lands and, crucially, how it is interpreted. The Nasdaq 100 is already down 1.85% today to 28,377 on the Nasdaq 100. Growth stocks are the most rate-sensitive names in the market, and a hawkish payroll read pushes discount rates higher, compressing multiples further. The S&P 500 is pressured on the S&P 500 with technical support near 7,400 now, clearly in view. Long-term treasuries, the long-duration bond ETF, is the direct hedge. A miss on the X-adjustment figure sends bond buyers rushing in. The Russell 2000 is under pressure, and small caps are disproportionately hurt by tight financial conditions. The VIX at 17.97, already up 11.41% today, signals options markets are bracing for a vol event. 3 specific levels define the trade going into Friday. First, the 10-year Treasury yield at 4.53%. A confirmed break above 4.60% on a headline payroll beat would signal that hawkish repricing has legs and growth stocks face a sustained multiple compression cycle. Second, the S&P 500 at 7,477 with support near 7,400. A hold there on a noisy but strong headline print buys the bulls time. A break below on a miss accelerates selling. Third, and most importantly, watch for any analyst commentary parsing the World Cup figure. If the true underlying print is closer to 75,000, that is below the hiring rate needed to keep unemployment stable, and the Fed's calculus shifts materially. Energy is the wild card. W&T offshore crude adds an inflationary signal that complicates any dovish pivot. The bottom line is this: do not let a strong headline payroll number on Friday be mistaken for labor market strength the Fed can lean on. Goldman's 40,000 World Cup adjustment is not a rounding error. It is the difference between a healthy labor market and one quietly losing momentum. With the VIX at 17.97, the 10-year at 4.53%, and the Nasdaq 100 already down 1.85% on the session, markets are priced for a hawkish outcome. The smarter trade is to watch the X-adjustment figure and the unemployment rate for the real signal. That is the story driving every rate-sensitive asset you own, and that is the one number that tells the truth about where the Fed goes next. That is the single story that matters today. Full breakdown is up. If you want this level of depth on every major macro catalyst before the market opens, hit subscribe right now and tap the notification bell so you never miss a breakdown. We cover the numbers that actually move your portfolio, not the headlines, the mechanics behind them. See you tomorrow.